just give it a couple of minutes for more people to arrive before we officially start. One more minute and we'll just let people arrive and then we'll start. Okay, I think we'll start now. Kia ora, everyone. Thank you and welcome to another Good to Know webinar from Healthcare Plus. I'm Alan Sharp and I'm your host for tonight. Before we start, I'd just like to apologise for the postponement of this webinar from February as I was a little bit unwell, but I'm fit and raring to go tonight to put your questions to our panel. And what an awesome lineup of industry experts we have tonight. I'm delighted to welcome back Liz Koh from Enrich Retirement, Ralph Stewart from Lifetime Income Retirement, Austin Fisher from Monument Insurance, and Charissa Mackenzie from Public Trust. As always, we asked you for the questions you wanted answered and you didn't disappoint again. Another huge response. And we could have done about 5 more webinars based on the amount of questions that were sent through to us.
We can't hear a thing. This is explaining something.
Can't hear me? Will I start again?
Video sounds a little first. Well, I'm on as a attendee. I can't go.
Hold on a second, people.
Yeah, we can hear you, Alan.
Put in a chat, you can hear us.
Yeah, can you just put in a chat if you can hear me? Because I think there's a couple of little technical issues floating around at the moment. I'll give it another minute and then I'll start again. All right, okay, brilliant. So sorry about that. I'll start again. Kia ora, everyone. And thank you and welcome to another Good to Know webinar from Healthcare Plus. I'm Alan Sharp and I'm your host for tonight. As I said earlier, for some of you that did hear, I apologise for the fact that the webinar was postponed in February, but I was unwell. But I'm fit and raring to go tonight and put your questions to our panel. And we've got a great lineup of industry experts. I'm delighted to welcome back Liz Koh from Enrich Retirement, Ralph Stewart from Lifetime Income Retirement, Austin Fisher from Monument Insurance, and Charissa Mackenzie from Public Trust.
This is full now. Can you talk with somebody else?
Yeah. Sorry, we're having technical difficulties with one of our panelists tonight. I think she's having connection issues. Anyway, as I was saying, we have an awesome lineup tonight. We've got Liz Koh from Enrich Retirement, if her dial-up connection will work. Ralph Stewart from Lifetime Income, Austin Fisher from Monument Insurance, and Charissa from Public Trust. As always, we asked you for your questions. You wanted answered and you didn't disappoint. We've had a huge response. We could have done a whole lot more webinars based on the volume of questions, but hopefully we've done a good job of distilling them down to a few general questions that represent most of the key issues that you wanted to hear. There were some specific questions that members sent through, and whilst they may not be appropriate to discuss on tonight's forum, we will try to follow up directly with all the members where appropriate and give them some feedback and guidance. So I'm going to pose the questions to the panel tonight, and I'm hoping we'll have a good conversation. We'll get a good conversation going, and I'm hoping as well that we will glean something useful from tonight. In fact, we will do a quick poll at the end to see if that isn't actually the case. So please make sure before you leave that you do our poll. However, I also want to say that during the session, if you want to ask any questions that come to mind, then please do. You can use the chat function or the Q&A function. You just need to click one and the screen opens up on the right, type in your question or use the chat. I'll monitor that throughout the evening, throughout the session. And if we have some time at the end, I'll pose some of them to our panelists. If we don't have time to do that, and your question wasn't specifically aired tonight, then we will be following up with an email which will collate all of the questions with answers as well. So look out for that. We'll also be recording the event, so you'll also get a copy of the presentation from us to either watch again or to pass on to friends and family. So I just want to check, have we got Liz? Liz, are you back?
I hope so. I hope so. Can you hear me?
Yes, you are. Okay, right. Enough from me. Let's get started. And so really, Liz, it's over to you, and I'll start with you. And we've had quite a lot of questions around debt and savings, and that's no surprise, to be honest. I think that's something that's on all of our minds, particularly this first question, which was how to manage debt and savings while still be able to live a little.
Yes, well, that's a really good question because life disappears really quickly. And of course, right now we're very tough economic times. And so people are saying, saving? How can I save? Because it is really tough out there with people struggling with mortgages and so on. So it is a question of balance. And, you know, balance is a word I use a lot when I'm talking to people about money. So I guess the thing is we need to try and make room in our budget for some savings, even if it's a small amount. And so with that savings, that needs to be allocated in three different ways. So your first priority is to pay off debt. Then the next priority is to have some short-term savings happening to, you know, just as a bit of an emergency fund or to cover those holidays and things. And thirdly, you've got savings for the long term. So we have to try and get a balance between all those things. So it's not a question of, oh gosh, you know, every spare dollar you have has to go against the mortgage or your credit card or whatever. There is a balance to be achieved. And I think the way to tackle it is to take a very long-term approach. So really, by the time you retire, you want to ideally have a debt-free home and some money saved up, KiwiSaver plus hopefully a bit more. And I think it's a matter of working back from there. So what we need to do is make sure our long-term priorities are taken care of first, because then you can spend money in the short term without worrying, without feeling guilty, you know, that you're not saving for your retirement or paying off debt. So the way to look at it is to set yourself a target for roughly how much you want to have over and above a debt-free home by the time you retire. And then the challenge is to try and get your mortgage paid off in advance of retirement, preferably, to give you still enough room once you've paid off the mortgage to save extra for your retirement. So if you do those kind of calculations, I mean, maybe you set a target to have your mortgage paid off by the time you're 50 or 55, and then whatever you were paying on your mortgage can go into to top up your KiwiSaver or your other retirement savings. So I think that's really the challenge, is to then work back from there and say, well, okay, if I've got to have my mortgage paid off by that age, then here's how much I'm going to have to repay. So, you know, once you've taken care of that, you know, try and set yourself that goal and be working towards that, then we come back to the short term and we say, well, okay, the first priority really then after that is to pay off any short-term debt. That's credit cards, store cards, that kind of thing, and to have an emergency fund. So you've got to have all those things happening at once at an amount that's going to, you know, make sure you achieve your long-term goals you're paying off your debt, but you've also got a bit set aside for holidays and that kind of thing. So it's not about doing things sequentially, it's about doing things at the same time, but just switching your priorities. So initially you're setting up your emergency fund, paying off your short-term debt, and then you're ploughing everything into your mortgage. Once that's paid off, you're ploughing things into your retirement savings. And if you follow that approach, then by all means you can still have a life and achieve your long-term goals. So I think, you know, it's just about thinking long-term and being disciplined in how you use your money. And also the key to that is creating that headroom to enable you to save so you can do those things. Oh, you're on mute, Alan. Alan, you're on mute.
Oh my gosh, we're having lots of technical difficulties tonight, and that includes user error by me. Apologies, I was on mute. Have we got anybody else want to add to what Liz was saying around that subject, or will I move on to the next question?
And I thought that was excellent, Liz.
Thank you, Ralph. Good to have you on board at last. Okay, so moving on, you talked a little bit about retirement, so maybe you can expand a little bit more on that. And what should we be doing to prepare for security in retirement? What do we need to be doing to make sure that we've got retirement in the bag?
Sure. So as I said earlier, ideally you want to have a debt-free home and some retirement savings on top of that. Now, my little rule of thumb that I use is, and this is very rule of thumb, that you have maybe half the value of your home available as liquid assets that can be used to top up your income. Now, that might be a bit of a stretch for some people, especially if you're living in an expensive area. But I think, you know, the big mistake that a lot of people make when they get to retirement is they're asset rich and cash poor. By that, I mean they've got most of their wealth tied up in their house. And that makes it really hard to have a sustainable retirement because, you know, you do need that extra money to top up your NZ super. So it's about really putting yourself in a position where you've got the balance right. So you've got a decent amount of money that you can tap into. And that might mean some lifestyle changes. It might mean selling your house and moving to a cheaper part of town or even a different geographic area. It might mean working a bit longer so you can build up your savings. So you've got a bit of a slush fund. But, you know, in my experience, people that don't have that slush fund are making themselves very vulnerable. And when we look at how costs have gone up lately, you know, we've got massive increases in insurance costs and food costs, rates, all those kind of things that take up a big chunk of retirees' budgets. And, you know, when you're in that situation where you haven't got an opportunity to add to your wealth, it makes it really difficult. So I think that's the challenge, you know, to have a secure retirement is to have that balance right, not to be asset rich and cash poor. It's really hard for people who are renting or still have a mortgage in retirement. And I'm sure Ralph may talk about this tonight, but you can also, of course, tap into the equity in your home through a reverse mortgage or some other sort of home equity release scheme. That's another way of getting around that problem. But yes, you do need to be able to get your hands on some cash. So that would be my advice on that one. Ralph might like to do that.
Well, Ralph, do you want to add to that?
Yes, and thank you, and a warm hello to everybody. Thank you for having me on board. But as Liz sort of lays out, it all starts with a bit of a plan. You know, a sense for direction. You know, the worst thing we can do is fail to plan because no one plans to fail. So it's really important to have a bit of a plan in place. As Liz points out, you know, in that plan comes, you know, what you want to do in your retirement life. So kind of that horrible Sunday afternoon, sit down and work out what it is you might want to do and coming to terms with the assets that you have. And when you do that, that moment of realizing what you want and what you have kind of creates some reality. And in that reality, you make an assessment of what you have. And a lot of people do ignore their homes. Cash at bank, your savings, your retirement savings, your retirement pot, whatever you might like to call it, can be augmented by your home. Our suggestion is that's later in life, though, not earlier. So in that planning process, you might recognise using the cash that you have, working for longer, a lot of things that Liz talked about, and perhaps later, from age 70 onwards, maybe using some of the equity in your home to prop up your income through retirement for the next 10 years of your life. A lot of people are ignoring their homes. They're an important asset when you're planning for an income in retirement.
And that's a good point, Ralph. One of the questions that came back, and I think you'll pick this up later on in the conversation, one of the questions that's just come into the chat is, can you explain reverse mortgage a little bit? I know that we weren't talking about a reverse mortgage, but I think it's important maybe later on when you talk about the difference between reverse mortgage and some of the other issues that are out there, some of the other ways that you can access the equity within your with your house, with your home, and with your the equity in your home. So we'll cover that off later, I hope. There are a couple of people, because we talk about planning for, but if you're like me, who's in his late 50s and hasn't had a plan, there are a few questions that have come in around what can we be doing at 55 when actually we're probably not retiring till 65, 70. We're still paying off our mortgage at 55. These are questions that if you want to answer now, Liz, we can. Otherwise, we can pop that into the follow-up post this webinar, because we will be answering all of the questions that come through on the chat. But I know that there are obviously a few people who are in their late 50s, early 50s, like myself, who doesn't have a plan as such, and is staring down, I guess, the barrel of retirement at some point in the near future.
Well, if I could just say quickly, I think if you're 55-ish and you still have a mortgage, just plough as much as you possibly can into that mortgage. And then when you get to the age when you want to retire, then take stock of your assets and your debts and restructure at that point. And that might mean converting your normal mortgage into a reverse mortgage. It might be selling up and you're moving to a cheaper property so that you get rid of that debt. There's a whole lot of strategies you can use at that point. But right now, just really focus on getting that mortgage down.
Yeah, okay, brilliant. That's awesome, Liz, and thanks for that. Moving on, we've talked a little bit about retirement here, and I just want to cover off a couple of things. There was quite a lot of conversation, quite a lot of questions around KiwiSaver and around super. And one of the big ones that came through, or one of the most popular questions asked, was around superannuation. Can we really rely on superannuation and our in the future? So I'll pass that over to you, Ralph, because I know that's an area that you're quite interested in and have some points on.
Thank you, Alan. Might start in terms of answering the question at the negative end of the scale and move to the positive. At the negative end, kind of find it almost offensive, if not disturbing, that something as important as national superannuation or New Zealand superannuation is politicised to the extent that it is. You know, it's become a political football, which is just wrong in my view. As we stand today with the coalition government, there's a proposal on the table, for example, that the eligibility age gets moved out to 67, and that's by 2037. ACT believe in the same thing, but they'd like to start the conversion to 67 sooner. And New Zealand First clearly have no indication that they would like to change the age of eligibility to 65 at all. I don't think there'll be any change to those debates, and I think if you can, you sort of push them out of your mind because they're not that helpful. Largely because I think they ignore the reality of being in retirement and the reality of the age of eligibility and the time at which people stop working. So we're talking about moving 65 to 67 in some period of time, in some fashion that's unknown, when in truth, about 25% of those people of age 65 or older now are still at work. So it's almost a bit of a mismatch, this notion of 65. The retirement age is when you wish to retire and when you wish to stop working. The age of eligibility is a separate issue and it relates to effectively government accounting. Thirdly is the affordability aspect. I see a lot of commentators talking about New Zealand not being able to afford NZ Super, which is hard and a difficult message, and I would imagine a frightening one for people. In my view, Alan, it's just not correct. If you look at sort of the underlying way in which New Zealand pays its bills and what those bills are, you can see what the true cost of NZ Super is. Today, of New Zealand's GDP, it's about 5%, call it 5.1. In the OECD, in the world in which we exist in, it's closer to 7. And it'll take us about 40 years to move from 5 to 7. So the noise we're hearing is I guess, more of a politicisation of NZ Super than a reality. NZ Super is affordable for New Zealanders for the next 30 or 40 years. If you accept that, that creates a couple of cohorts of people. And a lot of those are on the call tonight from Health Plus. If you're on the call and you're aged, I think, between about 50 and 55, I would not worry. NZ Super is affordable for you. If you're aged younger than that, perhaps between 30 to 50, there are some issues that any government of the time is going to have to face, and that's their own household budget. So in other words, that percentage of GDP, if 5% is spent on NZ Super now and 7% in the future, I think there'll be a rebalancing around how New Zealand spends its income on things like law and order, healthcare, education and infrastructure, which may, for the younger people on the call, impact how much NZ Super they get in the future. Thanks, Al.
And so is NZ Super enough to sort of get by on in retirement, or is there other options that we need to think about with regards to how we can get our pot of money that we need to retire on?
Yep. In an absolute sense, so in a dollar sense, NZ Super in an OECD sense is quite generous. It is quite high. However, it's not high enough. Massey University prepare a report every year which talks to how much you need to live in retirement. And it talks about cohorts of people and different lifestyles. But regardless of your lifestyle, NZ Super doesn't cut it for any of the lifestyles suggested. It still falls short, particularly so in a big city like Auckland, and less so in a rural community. So while retirees have just had an increase in the last 3 weeks from National, it still does fall short of a reasonable standard of living in New Zealand.
Oh, and there's a couple of interesting questions that just came in here, and we're talking about the NZ Super. And one of the questions was, is there a difference between NZ Super and the pension? I'm assuming we're talking about one and the same thing. It's your pension that you get from the government.
Some of these terms get fired around, and there are some old state pensions that are deemed to be a pension, but I think treating them as NZ Super is correct. Right?
Okay, I'll move on from the NZ Super, but I will also, it's a similar question, and this is to you, Ralph, and possibly Liz as well. How much money should you withdraw from your KiwiSaver account each year to supplement the government super? And I'll pass that on to you, Ralph, first.
I think I drew the short straw on that one, Alan. Everybody is so different.
I know you were going to say that. I knew you were going to say that.
Crikey. Where do we start, mate? I think,
but I think you made a point earlier about the Massey survey, because I think anybody who's in this stage of life, it's really important to have a look at that, because what they try to do, or actually you probably will explain it better than I do, but what they try to do is sort of identify ways of living, which is like a cheap way of living, a sort of middle way of living, and maybe a slightly more lavish way of living, and they kind of give you a budget, or they kind of give you a sort of target of how much that would cost per week. And I guess that's a good starting point. But I'll pass that over to you, actually, and I'll pass it on to you, Liz, as well, because I know you've talked a lot about this too.
Liz, are you happy if I go first? So agree, Alan. I mean, there's got to be, for your household balance sheet, there has to be two things. One, what you'd like to spend your money on, and two, how much it will cost. And the Massey survey does help in the second part of that equation, but it's up to each individual to do the first piece. In terms of the question, I think just answering it in the context of KiwiSaver is probably a little bit limiting, and thinking about all the assets in retirement that are available. KiwiSaver is still pretty young, 17 years, and the account balance is still pretty low. So if you think about all the assets out there in the retirement space, particularly term deposits, they're much larger than KiwiSaver. So the frame for the question is everything that's out there, really. So sort of work out how to apply retirement savings to generating retirement income is one of the most complex questions you could ask any individual to do fair. It really is. It's a challenge. And this is not an advertisement, and it's free, but we have a calculator on our website, lifetimeincome.co.nz. Would encourage your members to use it. It'll help you, and it's just there as a means of trying to help you. What it does is it breaks down the problem into component parts and helps you assess each of the components as an individual. So, for example, it assesses your age, your gender, the amount of capital you might have now, your tax rate, likely investment returns, your mortality improvements, and crunches them all together and does the numbers for you. Then it asks you a bunch of really important questions that you need to consider when you're considering how to spend your capital in retirement. And the first is really important: inflation. You know, a loaf of bread today costs a lot more in 10 years' time, and most people will be retired for 30 years. So it accounts for inflation. Your own personal tax rate is really important to get right. It accounts for that as well. And in some cases, it recognises that everyone's health is different. So some people will definitely live a shorter period than others. And when you think about how much you got in the bank and how old you are, and you divide by the years to live by your savings, that can be a very telling moment. So it's important you understand the mortality piece correctly.
And just on that, we will be posting a link to that calculator to all registered, everyone that registered for the webinar tonight. So I've used that calculator recently, and again, it was an affronting moment, but a good one to get the reality at my age.
Good man, exactly. It's completely free. It's not meant there is a sales tool. It's to help people.
And Liz, have you got anything to add? Because I know you've got an awesome guide out there, which I think is done through Lifetime Retirement Income around the buckets for retirement, and it covers some of this stuff too.
It does indeed. So look, I think it's a very personal. You need a personalised answer to this kind of thing, because not everybody wants to draw down their savings at an even rate through their life. And you know, I've struck people where, you know, for example, if parents died young, or they might have, as Ralph has already mentioned, might have health issues, they're not expecting to live a long time, and they might want to just, you know, spend a lot of their savings in those early years of retirement and then sort of sit back in the rocking chair and just have a quiet life. Whereas on the other hand, I've struck people who perhaps have immigrated to New Zealand, don't have any close family here, and they've said, well, look, I'm worried about who's going to take care of me at the end of life. And so I want to spend just, you know, a medium amount in those early years and have a lot saved for the end when I might have to pay for someone to come and look after me. So it's a very personal thing. There is no one size fits all. And the other problem that we have is that you're planning over a long time frame. It could be 30 years or so. And so what I like to do is look at, you know, how much do you need to top up your super over that 30 years just to cover your day-to-day living costs. Have that money set aside in a fund that you draw down at a regular rate. And then if you have any money left over, you might want to look at how much you spend in the first 10 years, the second 10 years, and the last decade, and just allocate it to those decades in different buckets. And then it means it puts a sort of more defined limit around how much you spend in a given time frame, which is a bit more helpful in terms of planning ahead. So, but yeah, there is a booklet available, and you can get that through Lifetime if you wish to know more about that approach to sorting out your retirement resources.
We'll also be linking that in a post following in an email following this following this webinar as well. So look out for our little email post this webinar with a lot of the resources and a lot of the further information on the points that we're talking about tonight. So last question on pensions and retirement and that kind of stuff. And it's just back to some of the questions that have come through actually on the chat. There's a lot of interest in the idea of reverse mortgage, both well, negatively and positively. So Ralph, can you just talk a little bit about reverse mortgage and some of the other ways that you can utilize the equity in your house? Because there's a few people thinking, oh my goodness, will the bank own my house forever, and will they kick me out if I can't pay back my repayments? So maybe you can just give a little quick overview, and then we can move into life insurance, and estate planning as well, which is another important part of financial resilience. But yeah, a couple of minutes, Ralph. That's all you've got.
Okay, Alan, as quickly as I can. I do believe the notion of releasing equity in your home is going to become increasingly important in the next 10 to 20 years, and will be not a major, but a significant contributor to the generation of income in retirement. There are two models, a debt model and an equity model. So under the debt model, you borrow from the bank and you don't repay the bank until you sell your house. Interest accrues for the time you live in the house, but you don't pay the interest on top of the principal that you borrowed until you sell the house. Normally that gets activated about age 60 or older. The interest rate is what's prevailing on the day. For example, in New Zealand today, to borrow is about 10%. So that means about every 8 to 10 years, when you add interest, the amount that you have to repay from the sale purchases of your home will double. That said, it's not an unsensible option for many people who don't have anything other than their home and NZ Super. It's a practical solution. It's suffered from historically, I think, a bit of a negative halo, the ambulance at the bottom of the cliff. I'm hoping people are going to realise that it's an important asset, equally as important as cash, and it can contribute to a better income in retirement. The other model is what we call the debt-free model, and it's one where instead of borrowing, you sell a part of your house every year for 10 years from age 70 for an income supplement to NZ Super. For example, a house with $1 million, you might be able to receive about $23,000 a year for 10 years from age 70 to 80 to supplement NZ Super. Under both models, you are guaranteed to live in the home for as long as you wish.
And so just to check, the reverse mortgage is the kind of term that everyone understands for the first model. Is that correct?
Correct, Alan. Correct.
Yeah. Okay. Cool. Brilliant. Thanks for that. Okay. So Austin and Charissa, you've been sitting there quietly for the last half an hour. So I'm going to turn to you guys now. There's an interesting question in the chat, which I'll talk to you, Austin, about in a minute. But let's talk about how much life insurance should I have, and what if I have no dependents, and are there age limits to life insurance? So just a general thing about life insurance, I think, Austin.
Okay, thank you very much, Alan, and good afternoon, everyone. It's very nice to join you all, and I hope you'll enjoy this little speech here about life insurance. I'll address these questions in a minute, but I was fascinated to hear from Liz and Ralph about retirement planning, because what it made me think was the monster kind of analogy. If I can take you to the film Alien, for instance, going back 40 years or so, the monster was really, really frightening, because for most of the film, you don't see what the monster looks like. And I think people think of retirement in that sense as in like, I don't want to think about it. It's too scary. It's just too much. But as time goes by, it's still not a very good, once you know what the monster looks like, you kind of get used to it. And also you can even grow to like it a bit. So what I'm saying is that frightening things are frightening because you don't know what they look like. So get the planning, as Liz says, together. And once you can see the full size of the monster and how many eyes and how many fangs it's got, starts to become less scary, and you get more used to the fact that this is something that you've really got to grapple with at some point. And actually you end up not being too scared. So anyway, bit of a digression, but I'll go back to life insurance now. So yeah, how much life insurance should I have? Now, this is where I'm going to get a bit morbid with everyone, because you need to ask yourself what happens if you die. And that's different for everyone, you know, because it depends on your dependents. Who you're leaving behind. What are they going to inherit from you? Would that be enough to pay off any mortgage or settle all the debts? You might well have money stashed away in savings to take care of all of that sort of thing, but you know, realistically, most people don't. So if you set up life insurance young, you know, you find the premium to be pretty reasonable, but then it does get more expensive as you get older. So that's really basically, by then you'll have stacked up, when you get older, by then you'll have stacked up some savings in KiwiSaver or any other kind of form of savings or equity in a house. So perhaps you don't need as much in life insurance. So it's a good idea to reassess your life insurance quite regularly, but be careful, because when you reduce the cover, it can be difficult and expensive to get that cover back again if you need it. So obviously you've got to do it very carefully. But that's the idea anyway, is that set up as much as possible, pretend that you're going to die. And I know that's the morbid thing, and what would happen next to the people that you leave behind. If that's not an issue for you, then, you know, arguably, if you have no dependents, you may decide you don't need life insurance. That's fine. But then I would seriously consider your thoughts then should turn to protecting yourself against long-term sickness or stuff that can happen to you then. But it's a good idea to reassess that life insurance which you have in place. It's not a done deal forever. Look at it from time to time, at least I would say once a year, to make sure that it's still fit for purpose. And most people would have an advisor to help them with that. Now, Alan, you asked me about the life insurance and the age, and what if I have no dependents? So did we?
Yes, that's correct.
Those questions?
I did. I mean, I think you answered it, to be fair, although maybe it's just good to point out that, you know, with regards to no dependents, I mean, when would you be looking at life insurance in that scenario?
Well, look, it's in. You warned me a while ago, Alan, not to say it depends. So I'm trying to kind of like skirt around using those words, but it really does. I mean, if you don't have any dependents or you don't want life insurance, I can't make you do it. So basically, most people find it a sensible thing to do, because, you know, most people do have somebody that's going to pick up the pieces once you pop your clogs. And I would say most people don't want to leave things in a mess when they go. I think it's a basic human instinct. Now, in terms of actually the cheapest way to cover yourself is basically to start with the big one, is if you die. Lots of advisors will get into the nitty gritty of all the kind of different kinds of insurances you can have. But I would start, if you've got nothing at all, think about, if you die, what happens next? Because that's the thing that's the cheapest thing to insure. It's also the most absolute. It's definitely going to happen unless something amazing turns up. But, you know, those are the two things that will definitely happen. And the more manageable, easier kind of insurance there is. But, you know, life insurance isn't everything. There's other forms of insurance that will be just as valuable to help you live your life if you're sidelined by bad health or you know, or you know, serious illness. Yeah, absolutely.
Okay, so the next one is really, what is the cost, particularly when you get to 65? Because you talked earlier about how premiums are a lot more expensive. Yeah. When you get older. And someone asked, should I consider asking my adult children to help with the premiums?
Look, that's I think that's absolutely on the agenda without a doubt. So, and I've got adult children, so, you know, I've certainly had that discussion with them. You know, I'm not sure they've taken me very seriously yet, but no, look, the cost when you get to 65, yeah, you control the cost really. If the premiums get too high, there's always things you can do to reduce the cost of the cover. just to give you an idea and to answer the question directly, I looked up an 84-year-old client, and for their $35,000 of funeral cover, it cost them $3,700 a year, just for $35,000 funeral cover. Now, look, I don't know the ins and outs of whether that is absolutely what they want. I assume it is, because basically they have, you know, regular reviews of their advisor. But it's absolutely worth talking to adult children who help pay these premiums, if they're the ones that are going to benefit from it when time goes by, because an awful lot of people, unfortunately, will let these things lapse when they get too expensive. So let's say your life insurance is now $300 a month, $500 a month, and it's just getting too rich for everybody's blood. You know, you let it lapse, and then it kind of becomes something that you can't reinstate again. When if you maybe spoken to the adult children, they could have inherited that. They could have taken some of that burden off you, because ultimately they're going to be the ones that will take that money as and when you die. Yeah, so whoever asked that question, it's a very good one. And it's one of those subtle parts of financial planning that advisors can be really good to wrestle out. So you won't see that in a policy document. You won't,
No.
It's just, it's just something which real life kind of trains you, is a perfectly logical thing to consider. Now, interestingly, somebody also asked about age limits, and funnily enough, with life insurance policies, there aren't any. In fact, one provider, they keep you covered after the age of 99 and pay no premiums for the rest of your life, but you've got to get to 99 first. Doesn't that sound like a life insurer's great plan? You know, like, wow, that's superb. In reality, though, the cost of life insurance becomes, you know, prohibitively high, really. And advisors tend to, well, they tend to have very focused sessions, especially at that 65 to 70 age, to say, look, okay, we mean it this time. Do you really need this life insurance anymore, or all of it, or some of it? If you've built up a lot of money in KiwiSaver, you know, or if your mortgage is not as much as it used to be, you know, you control the cost that way. And insurers know that too, because I suppose if you were 99 and you wanted to set up life insurance today and you were perfectly healthy, to get $1 million cover, you'd probably have to pay, I don't know, $1 million premium. So it's just the way it works is that you get a whole heap of cover early on when there's no pre-existing conditions to get worried about and to be and to get excluded at times. Now, there was something,
and that's a good segue into pre-existing conditions, because I guess what you're really saying there is that the earlier you can do it, and this is maybe around the question about dependents as well, the earlier you can get in on the lift, the easier and the cheaper it's going to be in the long run, albeit that the premiums will get more expensive as you get older, but then potentially you've got your adult children to help you take care of it. So I guess that's a summarized view of that.
Yeah, well, that's if you have that option, but no, if I may, I can address this quite easily. When you're younger, of course, you don't have as many pre-existing conditions, because generally when you're older, there's a risk that the life insurance company will say, okay, we'll cover you for everything apart from that thing that's wrong with you. Yeah. Which again is another charming life insurance kind of offer of terms that we know and love. But if you're 30 odd or if you're 20 odd, then you're pretty much in a kind of you know, usually you don't have those pre-existing conditions, but as they develop as you get older, you can get the cover for them. One thing at this point just to pick up on is that most people, or a lot of people, will have access to, or there'll be an employer scheme involved. I said most people, that's actually not true. Is that most that a significant amount of people will be able to access a group insurance policy through their employer. If that's available to you, don't ignore it, look at it. Make sure you know exactly what you're covered for. It might surprise you, particularly if you work for a big employer. There might be some life cover in there you didn't know about, or hadn't taken on board. Also, sometimes those group schemes have top-ups that you can do, usually a lot cheaper than doing it yourself, and usually a lot less underwriting. So if you're in a group scheme, and those of you on the list, you know, also think of your family as well. If your partner works for a big company, they might have something, and you might have heard your partner talk about, oh yeah, I've got this group scheme, and they're quite vague about it. Get your partner to be less vague, because it's really important. You know, you might be covered for quite a lot of money, and then that might save you money as well when it comes to planning for the future.
One question
yes.
that's come in here, Austin, which came through when Liz and Ralph were talking. This person says, I'm mortgage free. I've been saving a lot. But my biggest concern is health insurance, because when I retire, I won't be able to afford it. What's your advice on this?
There's plenty of things you can do with health insurance as well, but apart from, you know, yes, we're talking to the adult children again, but that's more of a kind of other side of insurance planning. Look, with health insurance, most providers have some different grades of cover. Like with Healthcare Plus, we have the Unimed model, which has some very basic cover, primary care extra, which pays for things like hospital visits and, you know, a certain amount of dental cover, things like that. Not or doctors kind of like very low level health insurance really. But then you go all the way up to the other end, where basically the health insurance is paying for, you know, quite serious surgeries, medically necessary $200,000 worth of surgery you could be insured for with something like a Southern Cross plan or the Health Select with Unimed, for instance. So it does get expensive, but you can always peg it back a bit like your home insurance as well, or your car insurance. They do operate with excesses. So if you feel to yourself, look, if you needed to have a serious operation and it's going to cost $50,000, if you decide that you can afford to pay the first 500, 1,000 yourself, then you'll find your premium will go down quite significantly, because you're sharing in the risk with the insurer. Things like that can do that. They're very highly modified, so you can you know, curtail some of the benefits, or you know, most people will consider as they get older putting in an excess so that they don't have to pay, so the insurance company isn't having to pay the full risk.
Yeah, I think that's probably what this person's talking about here, because clearly if you've got some savings and got some money in the bank and that kind of thing, then it's probably a prudent thing to look at what your premium is, what your premium could be if you add a higher excess into it, and then that way you could probably be reducing down the overall cost of the premiums on an ongoing basis.
That's right.
Can I still get life and health insurance if I have pre-existing conditions?
The answer to that is you sure can, in a group scheme. Let's say you're lucky enough to be part of a company that has that. It doesn't matter. They're employing you. There is usually no barrier there. It doesn't matter what you've had in the past. You'll be covered. But that's a bit of a hurdle to jump, you know, to find an employer that's got a generous group life insurance scheme or health insurance scheme. But enough people are covered by that sort of stuff to benefit from it greatly, honestly. Yeah, I've seen in my job so many people benefit from that. They wouldn't have got the insurance elsewhere. Ultimately, if you're on your own though and your employer isn't doing anything like that, then usually your pre-existing conditions will either be excluded, or the insurance company will charge you more than they would have done for otherwise. You know, they'll what they call loading the premium if they think that you're on a higher risk than most other people of your age. So yeah, yes and no.
So basically, you can. It may cost you a little bit more, or these conditions, and from a health perspective, may not be covered, but you'll still be covered for other things, or there'll be a loading against you on life insurance.
That's right, unless you're lucky enough to be in a group scheme at your employer.
Okay, and finally, let's get to you, Charissa. You've been sitting here nice and patiently for quite some time. I guess one of the other major parts of financial resilience is ensuring that you are looking after your assets and ensuring that you can pass them on in the future. So wills are an important part of protecting what's important to you. So let's talk about wills for a bit. So a couple of questions that I've got here for you. My assets are all jointly owned with my partner. Do I need a will?
Thanks, Alan. So from our perspective, there's picking up on the KiwiSaver conversation, my understanding is there's about, as of last year, there was about 3.5 million people that had KiwiSaver in place. So it's likely that the majority of people are going to end up with at least $15,000 in their sole name, perhaps from that alone. KiwiSavers can't be jointly owned. So therefore, if you have assets in your sole name over the value of $15,000, an estate administration through a formal legal process called probate is required. Even if your assets are jointly owned, you do have to think of the inevitable that unfortunately in the event of when you both die, there will be an estate to administer. So without a will, it is time consuming and expensive, and it may not be distributed as you want. Or even if you followed the legislative process and went, oh, you know, under that act, that's what would happen. It may not happen because there's some claims that may be made against the estate. So just to give you an idea of the legislation, just quickly, if there is a spouse or partner, but no parents or no children, then it's relatively standard, subject to no claims being made. The spouse or partner will receive the whole estate. However, if you're looking at a situation where there's either parents or children, then if there is a spouse or partner and children or other descendants, then the spouse receives the deceased person's chattels plus their first $155,000 in their sole name, and then 1/3 of the remainder of that person's estate, and the children receive the remaining 2/3. If there is a spouse or partner and parents but no children, then the spouse or partner receives the chattels, the first $150,000 and 2/3 of the estate, but the parents actually receive 1/3 of the estate. If there was absolutely no descendants, then yes, everything would pass to the estate of the government in that case. But also have a think about blended family situations. You may own things jointly, and that maybe that's convenient or suits for you, but have you had that conversation about what happens or what is your expectations when you die? Because you might have an expectation that's not actually able to be legally followed through in that way. So it's well worth, if you're in a blended family situation, having a comprehensive conversation with a solicitor, trustee firm such as ourselves as to what you actually want to happen, and making sure that your wills actually match up to that. And I was just going to quickly mention that an example of a claim that was made on an estate of somebody who died without a will wasn't actually a family member that made the claim. It was actually the neighbour's children, and they actually ended up receiving a farm some years ago valued at 1.4 million, and that was actually because the neighbours provided meals and included the deceased as a family member, so they made the claim under what was the Family Protection Act, but from it, even though they weren't a blood relative. So you never know what can happen.
Bloody hell. Okay. I'll not be making sure that my neighbours aren't giving me any food over the next wee while. You've talked about having a will. If people have wills, do they need an enduring power of attorney? And maybe what is an enduring power of attorney?
Yes, so an enduring power of attorney, a will is absolutely no use whatsoever during your lifetime. It's fabulous when you pass away, but it's got no legal authority during your lifetime. And a lot of people still have the perception that next of kin means something. It doesn't. Children, I'm the next relative. It doesn't actually have any legalities. We've got the likes of the Privacy Act. We've got the Protection of Personal and Property Rights Act in particular that says that's not the case. And even the Land Transfer Act has a say on that sort of matter. So anybody over the age of 18 should have an enduring power of attorney in place, which makes that decisions and information and actions that need to be done for that person, particularly if they lacked capacity to do so themselves, can be done without court proceedings. However, there's other situations to think about. For example, I always use me as an example. In my first marriage, we were in a situation where my husband was away a lot. He worked overseas. And so often he was never, I swear he was never around when the mortgage was due to be renewed or when there was tax due. Possibly it was a sign for me later on in life, but anyway, in all seriousness, the ability to then sign, I could sign documentation on our behalf, quite with his agreement. And equally, for example, if we were midway through selling the house and he was away or something like that, I could do so. If you're in deteriorative health, you may still have your faculties, but your ability to cope maybe with filling out forms, going into town and dealing with certain things you just don't want to do, or you need some help, that gives the authority to somebody to help you who you want it to be. And yes, if you're mentally incapacitated, it helps. It significantly helps in that situations. And if you're immobile, you may have your faculties, but you're stranded in hospital with broken bones, there's bills that need to be paid, things like that. Yes, I appreciate that technology may be able to help, but not everything can be done in that way. So just very quickly, there's two types: an enduring power of attorney for property, that's anything other than your body, who makes the legal and financial decisions if you're not able to. And then there's the decisions about your body, that's the enduring power of attorney for personal care and welfare, who makes decisions about your health and well-being. If you don't have them in place, again, it's not automatically defaulted to anybody. An application has to be made to the court. It's referred to a judge, and the judge appoints a solicitor to investigate on behalf of the incapacitated person. If the judge agrees with the findings, he may do an order. If he doesn't agree or there's disputes by other parties, then it goes full to a hearing. And the appointment only lasts no greater than 3 years, and you have to submit your accounts to the court to be audited. Interestingly, we're the court order appointed at the moment, and you have to have all that paper trail audited to report to the court on it. Whereas enduring power of attorney, it has immediate effect. You don't have to submit your accounts to the court. There is accountability and liability for that person should they do anything wrong, but not to the degree of the prerequisite requirements. I just wanted to mention there, which I'm sure you're picking up on from the life insurance and KiwiSaver things, that statistically life expectancy has doubled over the last 200 years. It's clear we're all living much, much longer. There's a big debate over the ability to resource that within New Zealand, which is a whole separate issue. And then another interesting statistic that Age Concern you may hear has shared is that 70 to 80% of abuse occurs at the hands of family. Now that can include financial abuse. So you determining who you want to be involved in decision making and the right person is vitally important.
Brilliant. You stole a little bit of my thunder there. That's what I was going to say around the fact that we are all growing older, and so enduring powers of attorney suddenly become a lot more important as we get older. Finally, I mean, I know that with wills and legal stuff, there's always big words and things like that. And executors for wills came up quite a lot in the questions. What do I need to think about when choosing an executor for my will?
I think it's a really good question, particularly we're a country of DIY. We like to do things ourselves. We all agree to things. We go, oh yeah, we'll help you out. We'll look after you, that sort of thing. And the reality of a role can suddenly be faced when you can't back out of it, or you're maybe faced in situations of uncertain ground. So just something to the things that I think of in the 28 years that I have been with Public Trust. Obviously, there's an obvious one: grief. You may personally know that person. You might not actually respond as you think you are, but you are suffering grief, and there's a lot to cope with there. I relate to my own situation when my grandmother passed away of an accident. I'd been by her bedside for a number of years, number of days, as well as caring for her for a number of years. You're exhausted at that point in time, and to get your brain into that zone of the legalities is a challenge. Conflict. You may be bringing into dynamics estranged relationships, blended families that maybe haven't actually had to intertwine at that point, and all of a sudden they're all in the mix and have expectations and past grievances or current grievances that you may need to be dealt with. Time. I did a quick research. I think from my thing, I think you need to anticipate that realistically, even if there wasn't a house to sell, that there's at least a good 20 hours of work involved with that. Houses at least over 35 hours of work. And that with that comes paperwork. There's lots of paperwork. There's legal applications, tax returns, financial statements, and communications to the beneficiaries. There also may be you faced with legal interpretation of a poorly written will or an old will that's not relevant to now circumstances, and you've got to bridge that gap as the executor and trustee. Transparency is a vitally important part of the role. The person is fully transparent, but they're also equally held liable for their actions, and they are held liable for the timeliness of it, the actions, and the costs incurred. Just as a matter of interest for public trust, we're a Crown-owned entity, so our transparency flows all the way through the ministerial component of our role, but we also, to ensure our transparency, we are involved with the financial services complaints organisation, so they will independently review our fees and charges at no cost to the beneficiaries of the estate to ensure that our charges have been fair and reasonable. The key thing I also just wanted to sort of close off in there is that when you are an executor and trustee, you've got to get used to the fact that you will be wearing what we refer to as many hats or many responsibilities. There may be beneficiaries that you have a close relationship with. There may be others that you don't even know, or that you have an estranged relationship with, and legally you must remain neutral. The court has endorsed this and held executor and trustees liable for that if they can see that you haven't considered both the needs of beneficiaries as appropriate, but also it could be claimants, people that have made claims. You have to adopt a neutral stance in that regard. And so an executor and trustee holds a lot of responsibility, time commitments, financial liability, and even may involve court proceedings if the will is challenged or their actions are challenged.
Okay, thanks, Charissa. And clearly we have completely run out of time. And that's probably due to the sort of the little technical difficulties we had at the start, and also the fact that I talk too much, and so does Austin actually. And so, so I apologise to everybody for that. There was a lot of good questions in the question and answer section, so we're not going to ignore that. There was quite a few questions from people in their mid-30s and younger who are feeling like everything's a little bit hopeless. And so we're going to put some thought into some of these questions and some of those areas, and we'll come back with some information and resources and stuff around that, I think, going forward. So sorry that we couldn't answer all your questions, and there was actually a lot of chat in the chat as well, so everybody's pretty engaged. Just quickly before we go, I'd like to just put up the poll and just ask everyone if you thought that this webinar was useful. If you could give us a star rating, that would be fabulous. I'd also just like to thank all of our panel guests tonight who have been giving us such brilliant pearls of wisdom, and hopefully we all gleaned something of interest out of that. I also want to thank everybody who turned up tonight in their numbers. It was great to see, and I hope you have a fabulous evening. And just to remind everybody that we'll be following up on this with a copy of the recording, so you can read it again, and you can pass it on to friends. We'll also be sending out a whole lot of resources. So the people who are asking for things around lifetime retirement incomes calculator and things like that, we'll be sending all of that out, plus many more other things, including Lizzie's fabulous buckets for retirement. So Thank you, everybody, for turning up tonight, and really appreciate it. And we'll see you next time for our next Good to Know webinar. Good night.
Thank you, everyone.
Thanks, everyone. Good night.
Bye-bye.
Bye-bye.